Oh, it's on the screen. Now we see you.
Oh, cool. Let me, yep, I can post this link in the chat.
Yeah, I can do it. Thanks.
Yeah.
Cool.
Okay, let's. Cool. Can you guys all see these slides?
Yes.
Okay, perfect. So, sorry for the delays there. We're here now, and thank you, Brian, for the introduction. One thing I want to clarify before we start, I was hearing the end of talking about Lima. Is that correct? And it's not like I heard it was doing something similar about offering a baseline yield.
Yeah.
Yes.
Okay.
Yeah.
That basically say that you have something in a yield firm somewhere, and that will give you a baseline of X% no matter what, in addition to what the derivatives are doing.
Yep. So I was talking about juice.
Oh, okay.
Yeah. So that's yeah.
Oh, okay. So, yep. So yeah, basically, sort of at the high level, as Brian said, juice is it's a yield farm actually in name only. Juice itself is not an AMM that is yielding out for putting money in there. But it will look a lot like one. So the fundamental thesis of juice is that perpetuals, which are basically a derivative, that pays out some amount of funding regularly, basically like the crypto derivative, both centralized and decentralized. They are usually paying money to shorts, which basically means that people are paying the shorts of the derivative money because they want leverage to go long. And what this means as a trader is you can think of a trade where you say, oh, well, what if I buy 1 Bitcoin and I sell a Bitcoin perpetual? I'm not taking any, if Bitcoin goes up or down, one side of that trade makes the same amount that the other side loses, and I collect that money or the funding payments. And this trade is actually one of like the major cornerstones of, basically, I would say most like market makers in crypto. And analogous versions of this trade are sort of a cornerstone of many market makers in traditional finance. And Juiced is basically sort of trying to make like the same sort of trade easily accessible to like anyone to put USD in. So, oh, there we go. So there's a high level overview of what Juiced is doing, and sort of one sense is that we are building managed derivative and farming products on chain, largely using Serum and other products on Solana. And the sort of three cornerstones of Juiced are these things. One is rates arbitrage, and that's basically a fancy word for what I just described, is that some variant of, you see perpetuals are paying shorts money. So you go long, a SOL, short a SOL perp. You don't take risk on the price of SOL and you collect that. And more generally, it can mean doing something similar with borrow lending protocols, integrating yield farms, basically, finding some combination of positions where at least one side of the position is paying you money and the other sides are either not costing you anything or they cost a lot less than the sides that pay, while hedging out your price risk on the actual products that you hold. So the next thing in line is what I would call portfolio optimization. And the idea behind this is that basically like the best thing to do with your money at any one point in time is changing. The really simple example is if like one day, maybe it's like Bitcoin perpetuals are paying, 40% a year to shorts. But for some reason or other, as a month goes on, Bitcoin goes down to paying 10% and SOL goes to paying 50%. And so the thing that you want to do is sort of start reallocating your capital from the Bitcoin trade to the SOL trade, because you're simply getting a lot more out of the SOL trade. And it's not meaningfully changing the underlying risk you're taking, because you're basically in a pure interest rate position. And again, you can extend this to just sort of like with rates arbitrage, generally finding the best combination of positions across products in the Solana ecosystem to both maintain delta neutral and also collect payments of a sort. And finally, the project will hopefully be actively engaging in providing liquidity on the various order book venues. I'll sort of go into and the high level reason for that is you can get significantly better execution that way than if you are simply sending limit orders and eating the spread, as well as a 10 basis point trading fee. And due to the nature of these projects, the protocol will need to actively trade as things move. Just going a bit more into the specifics of what these mean is sort of as I said, with rates arbitrage, you find some basket of products that are delta neutral and get you the most for your money. So this neat little diagram over here, some idea behind it is maybe, you go short a Bitcoin perpetual on Mango, you buy your Bitcoin spot on Mango, so you have a hedged position. But you don't actually have to put all of your Bitcoin spot on Mango to margin your derivative. You only might have to put half or a third of your Bitcoin there to be safe. So then what you do is you can say, take the other 2/3 of your Bitcoin and stick that in, Saber, or whatever the best place to put that Bitcoin is at the time. So instead of sitting on Mango as collateral that's not needed, this 2/3 of a Bitcoin is actually being productive somewhere else. Portfolio optimization, if you look in this example, it could be that 1 month Saber is paying you 20% a year. The next month it costs 20% a year to borrow a Mango on Mango. Borrow a Bitcoin on Mango. So what you actually want to do is you might as well just leave your Bitcoin on Mango being lent out. And the liquidity provision is sort of one thing that you might have guessed is, as you're moving all these positions around, you have to engage in trading. You also actually have to engage in active trading for margin management. Because even though you are delta neutral, you will, as prices move, you'll either start taking more leverage, or you will start taking a lot less leverage and have capital that's not being very useful. So the Juice protocol will have to be actively trading as the markets move. And providing liquidity is a very good way to lower execution costs, because at least on one side of your order you can not, instead of crossing a spread, which are still fairly wide, and paying fees, you will earn the spread and the trading fees. At the moment, volume on the Solana exchanges isn't extremely toxic, which means that if someone trades against you, it might not be jump trading, realizing that you have a bad order out and taking your lunch money. It's just that someone legitimately wants to trade and you're providing liquidity. But there are some pretty basic strategies that sort of obviate risk that you only get filled on one leg of your trade. One being that you have some software that is you're either cranking this at a high enough frequency so you always see when you get filled and go hedge. Or you can actively look for when your order is going to get filled and make sure that you are sending enough cranks to the protocol to make sure that it hedges quickly. And this is a very good and straightforward way to save costs. If we want to actually go through a worked example that is probably still real right now, is that sometime this afternoon, the perpetual on Mango is paying 50% to shorts. It was cost maybe 10% a year to borrow a USD on Mango. And I looked at a few of the stablecoin farms, and they were paying about 20%. And right now on Mango, you can, with this, enter a position that does not take risk on the price of Bitcoin. So Bitcoin goes up, Bitcoin goes down, you don't particularly care. So very similar to a stablecoin farm, but it pays much more than 20% a year. The first iteration of this is sort of a trade, the cash and carry trade, which I've talked about more than one time already here. So sorry to keep repeating myself, but again, like very, very straightforward. You short a Bitcoin perpetual, buy a Bitcoin spot, and you hold that position. And the moment in time funding is going to be paying you 50% a year. So that's already quite good. And if you, if you are willing to take more risk, one thing you can do is leverage this. So you might say, okay, I have 1 Bitcoin of collateral, and I'm short 1 Bitcoin perp. So my position size is, I have a leverage of 1. So you can then borrow 1 Bitcoin's worth of USD to buy another Bitcoin, and you short 1 more perpetual. So now you have 1 Bitcoin, you've borrowed USD to buy another, and you've shorted 2 perps. So you've taken some amount of leverage. You're 3x leverage now, in that you have liabilities that are 3 times the amount of capital. However, you're still in a market neutral position, and since Mango in this case is cross-margined, your position is fairly stable. If the price of Bitcoin goes down, you immediately realize a lot of USD from your derivatives or from your perpetuals, and that's fine. You've made a lot of USD, so you're actually becoming less leveraged if Bitcoin goes down. And if Bitcoin goes up, you will start taking more leverage as you realize a USD loss and go negative USD from the derivatives, but your 2 Bitcoin are equally growing in value as collateral. So it's not completely risk-free, as eventually you'll take so much leverage that the exchange would liquidate you. But this is one reason why Juice is actively trading. The prices have to move huge amounts for you to take too much leverage in this case. And it's very large because of the offsetting position. It's not like a normal 3x long position where if the price moves 30% against you, you get wrecked. So it's still fairly safe. It takes some more risk, but now you're looking at a 90% yield. You're getting 50% times 2 from your Bitcoins, and you're paying 10% to borrow. And one of the things we plan to do is offer, products that sit along various points in this risk reward spectrum. One is, you can say, have a class of products that take absolutely no leverage. Again, short Bitcoin perp, buy a Bitcoin, leave all of your Bitcoin on the exchange. And that can be a whole class of product for someone who's very risk averse. Or is really worried that the perpetual funding will start paying a lot to longs more quickly than the protocol can enter that position. All the way to trades like this one, where you borrow USD to enter a more leveraged cash and carry position, where you're still market neutral, but there is some degree of higher risk taken in that and the protocol will have to trade more aggressively to make sure that you stay, that your position doesn't get too large.
Okay.
Apologies.
Thank you. Yeah, this is very helpful to see very detailed how this stuff works. Because
yeah. Actually, I'll talk about another example I didn't write down that's very similar. I think I briefly mentioned, whereas you do the same trade as number 1, short BTC perp, buy a Bitcoin. But instead of taking more leverage on your Bitcoin, you can send that Bitcoin off to somewhere else. So as far as Mango sees, you're short 1 Bitcoin and you are long 1/3 of a Bitcoin. So you're pretty leveraged. but the rest of your Bitcoin is actually off, like being lent out or in a yield farm, or like who knows what it's doing. All that really matters is that you have 2/3 of a Bitcoin long position doing something productive. And this is where Solana is really amazing, which is that you can send your Bitcoin straight back into Mango on a moment's notice. I've worked in crypto quant trading and like personally witnessed, situations where someone has a trade like this. You're short a derivative somewhere. Actually, usually it's that you're long a derivative somewhere. A big liquidation spree happens, and the market starts going down 10-20% in 1 minute. And all your collateral is at a different exchange than your derivative. And you hit send, and all you really do is like helplessly watch as your position gets liquidated, and then 2 minutes later, a giant amount of collateral lands at the exchange.
Yes.
That's just not, that's a drastically lower risk on Solana if your time scale moves from like 10 minutes, 5 minutes to 5 seconds, 10 seconds worst case. Like it's very heard of for like coins to drop 50% in 10 minutes. Not common, but like if it happens once a year, it's gonna happen to Juiced. Coins tend not to drop 50% in 10 seconds. And I think in cases where they do drop 50% in 10 seconds, you were not getting out of that happy no matter what.
But are you sure? I would assume if a system is just faster, then also these kind of reactions will be faster of the whole system, basically.
Yeah, I guess the only case where I think that would happen if there's a complete rug pull.
Yeah, of course.
In theory, if there's a complete rug pull, okay, if there's a complete rug pull, your short position is fine.
Yeah.
The risk from liquidation comes when like you get liquidated at 30%, the market moves down 50%, and then it goes back up to 20% down. That's when you actually come out of it very bad. So if things go straight to zero, then like one side of your trade is making 100%. But so it's obviously a very bad.
Which state are you? Are you like is the product ready, or are you still in the development?
Yeah, we are still in the development stage. So I'll elaborate a little bit more on that. There is a more or less working version of the product. One is that we are still just like doing a lot of like validation and testing work of the product. Obviously, in DeFi, you have a lot less escape hatches if there's a bug. There's reasons for that. We're also working on monitoring and alerting software, just so that like, we don't want to wake up to a surprise or wake up to like something bad where like maybe there was something we could have done. The other reason is that Mango is not particularly liquid. None really of the on-chain derivatives exchanges, I think, or fully decentralized like on-chain derivatives exchanges are particularly liquid, and that actually poses a problem for Juiced because derivatives are not fungible between, say, like Mango and FTX. So if you're on Serum, like you can trade as much spot as you want in Serum. I will, as a market maker, sit on the other side of your trade and trade spot like 5 basis points good to FTX all day long, because I can just send spot back and forth and it's a true arbitrage. But you can't do that with derivatives. They're sort of stuck in Mango.
Okay.
And if Juiced is, say, trading in only one direction for size on Mango, if you're doing it on a book like even Solana, which I think their biggest book had $10 million of volume today. So if you release this and then like people are putting in $10 million a day of volume, you have sort of one directional long-term position holding volume going in Mango in one direction. And that can really aggressively hurt yields there. I also have a suspicion that a lot of the liquidity being shown on Mango is only there because people are getting Mango rewards. And the instant they start getting filled for any amount of size, it's all going to go away.
Yes.
So we're also working with some people to help them get set up to actually be providing real liquidity on Mango with some amount of size and like a knowledge that they're actually going to trade and not just get Mango rewards. And that,
okay.
So we expect that we will be able to release the product sort of like late December. It's a pretty conservative estimate, but I feel like it's always better to be like a few weeks more conservative than make too many promises. And you know, it's better to release these things when they're ready rather than like rush something out the door.
Yeah, I don't know. We try to keep the sessions around 20 minutes or so. So do you have a lot to add, or?
This was largely the meat of it. Let's see, there was.
Hey, there's some question in the chat. Maybe you can.
Oh yeah.
I can read them, or
Oh,
you can.
I didn't even see this. Okay.
Yeah, that's okay.
Yeah, here's a question. Once the drift trade is open to all, are you planning on also integrating? The answer to that is yes. Like our view is that in general, we want to be anywhere where you can get yield of some sort. Whether like drift would be the first thing we integrate when it opens, it's that's unsure. It depends on the contract specifications, how the protocol works, how much liquidity is there. One sort of, I think, underappreciated things about perpetuals is that it's sort of subtle to price them properly if you're comparing one perpetual to another. So even if a long-term two perpetuals are paying 20% a year, if at a point in time, if they have different funding cycles, you might actually be losing like 6, 7, 10 basis points a trade if you're just very naive about entering them and you enter them at like poorly priced times. So the only real catch here is we'd probably want to be careful about like if the contract works differently, making sure there's some logic to make sure that we're not doing like bad arbs or garbitrage, as someone used to tell me. But like other than that, yeah, if there's a derivatives venue, if there's a yield farm, a lending protocol, it is on our radar for something we would want to integrate with.
Can you talk a little bit? So are you going to have a like governance token, and what's the relationship of these like yield generating positions to that token, or are these just going to be vaults that would then return profits in, say, Solana or Bitcoin?
Yeah, so unfortunately, the advice I have gotten from legal counsel is if the token is an avenue to return products, we both have a security and I am also at risk of going to jail. So we don't have immediate plans to give profits back to the token holders directly via the token. What we do, however, plan is that token holders will get significantly reduced fees on the protocol. As for governance, so there are a few ways this will it can play out. One is that like it's going to be there's going to be some questions about like what new protocols do we add? Like do we go for like if there's 20 different protocols, we can't just like add 20 different protocols in a week. So there's some questions of like what do people actually want to be integrated with? There's going to be a lot of questions about what products do we trade? Because there's going to be like some risk reward balance of like, do we want to integrate with this like really new coin on a really new yield farm that's giving like 20,000% APY? Like seems great, but like you also might get completely rugged. So those are questions that would probably be like opening up to governance. Yeah, I see. The next question is, why would I use Juice over UXD? UXD seems to do the same, but I would also get a stable coin. Yep. So I have two thoughts on this. Brian sort of answered one, which is that, as far as I know, UXD is not being as aggressive about finding sources of like rates and yield. The other thing is that we thought about offering a stable coin. But as someone, as Tom mentioned in the chat, like stable coins come with a lot of, I'd say, bank run risk. Like if a juiced vault, if something happens and a juiced vault loses 5%, that's really unfortunate. But it's not an existential crisis for juice. Like it's advertised as a product that carries risk of some sort, and it should be low risk, but like it's a risky financial product. If I tell people that a juice token is equivalent to 1 USD, but you get yield, and I make all these promises that it's going to be a stable coin, and then I lose 5%. Now there's probably going to be a bank run because you're clearly not stable. So I sort of view stablecoin as like, this almost fits the bill, but I think that it's adding a lot of risk that you go down just a little bit, rates move a lot and the funding goes bad and things start to drop a bit, and suddenly people are looking at something that has lost its peg.
Yeah, I did just see a deep peg event last week on Curve, and yeah, it's a lot of risk. And the thing is, if people see this risk, they won't use it as a stable. Basically, they only use it to get access to other farms to farm it, but there's little chance that you get really into the system be used as a stable.
Yeah,
That's what I see.
It. Yeah, I see it as like even with the lowest risk trades, it's sort of risky because I do not believe this is a risk-free trade. I think it's a low risk, but I would strongly assert it's not risk-free.
Yeah.
And
but it's a good story to tell, the story itself.
It's a good story. You're delta neutral. Where could there be risk? Premiums will always pay to shorts, which is true until it's not. But also I think it would really prevent us from going after opportunities that bring on more risk and bring out significantly outsized return. Sort of like there was an example I brought up where you leverage and you're still delta neutral and you take some more risk, but you just doubled your yield. And we're also considering down the line adding trades that aren't completely delta neutral.
Okay, I think the time is running up a little bit. Sorry to interrupt. We have like a second presentation, so I know if they're like last question, maybe we can have them now, or we have to move on. I'm sorry. Yes, Yvette, do you want to ask anything?
So I think the core of this question, are we capable of implementing a non-EVM, non-Ethereum yield strat at the moment? I think the answer is yes, because this is a non-Ethereum EVM yield strat, if I understand it. I mean, it's happening in my personal account.
The question is more to us as a entity. Alnidao is heavily focused on EVM. Because in fact it's not. We are technically agnostic because it's not. We have a product, but the boule itself, it's like the main thing in this project. But we can right now we cannot. But maybe we can over time. We can go to other chains too. It's just a matter of resources.
Yep, definitely.
Yeah. So thank you very much for your presentation. There's been. I did get better what you are doing or what these kind of trades, how they work, and thank you very much.
Hey, thank you guys for listening to me ramble for 40 minutes.
Yeah, cool. Thank you.
Hey.
So Rodney will present Maple as next, and thank you very much.